Well, hello and welcome everybody to what is actually our first Simply Tax Talks live stream here as FORVIS. We last kind of left off as we were heading into the summer months at the end of May. We were talking about where things stood and how Build Back Better was basically dead. And we're going to get the band back together here today and talk about what's happened. And I'll have Yelena kind of set the stage for that. But I'm excited because not only is it our first as FORVIS, which was we as a result of our merger of equals between BKD, CPAs and Advisors, and DHG that was effective on June 1. We have our new name and kind of our new group, but we also have probably our largest group on Simply Tax Talks that we've had to help break down the bill that's informally, I guess I'll say, known as the Inflation Reduction Act of 2022. So I want to welcome Yelena back, as well as Adam, Derek Smith, and Phil Lamanick. And that's Adam. You're gonna have to help me with your last name, Adam, because I don't want to butcher it, because I've seen it many times, but I don't want to say it improperly. So help me out with the pronunciation of your last name there.
Yeah, it is Niparadny.
You got it. All right, that was what I was going to go with, but I'm very sensitive to that, so I want to make sure we get it right. So, all right, everybody, as you know the drill, if you're watching, hopefully, we've got the comments. We're watching those. We love your questions. We're here to answer your questions. So please get them in there as we go along the way. But what we'll do is we'll go ahead and jump into our top tax topics for today. All right. So I think I kind of laid it out there a little bit that it's been an interesting probably couple months, I guess I'll just say. We were really focused, particularly in the end of last year, and we started these Simply Tax Talks last October, actually, with the buildup of the Build Back Better and the chance of significant tax change. And the question that I often would ask Yelena, right, was, are we going to see significant tax change? And what's going on in Washington? So Yelena, fill us in. What's happened and where are we now?
Well, 18 months later from when this all started and everyone had their doubts that this would go anywhere, I know if Tad was here, he would tell us that this wasn't going to go anywhere, because honestly, for a while there, we all thought Build Back Better was dead and wasn't going to go anywhere. If you remember last year, at the end of last year, Senators Manchin and Sinema kind of put the brakes on everything. And even in the new year, there was rumors that negotiations were restarting, and then they died and they restarted again. And then the inflation numbers came out, and Manchin kind of put a halt on everything and said, with rising inflation, we don't want to pump more money into the economy right now or pass any major policies. And so, to everyone's surprise, in late July, Senate Majority Leader Chuck Schumer and Manchin announced that they had reached a deal for a reconciliation package, but it was a smaller deal that, due to an agreement made with the Republicans to pass the CHIPS Act, they decided, we're only going to include two major provisions in this reconciliation bill, and those were non-tax provisions. So there's a provision to allow Medicare to negotiate prescription drug pricing, and then extending Obamacare premium subsidies for 2 more years. A few days later, though, everyone was completely taken by surprise, including the Democrats, because the two senators announced that they had kept talking and ended up reaching a bigger deal, and that included tax and climate energy provisions. And so everyone was kind of shocked and waiting for more details. At that point, we only had legislative text for the two provisions for Medicare drug prescription pricing and the extension of the subsidies. But we had no text or context for what was included in the tax and energy climate provisions. But shortly later, we did see some summaries come out, and then later legislative text was released with all the provisions written out. But the original proposal included a provision that would allow a change to carried interest rules for private equity and hedge fund managers. And it would basically tax investment manager income as short-term capital gain versus long-term capital gain, as it is under current law, which means it could be subject up to a rate of 37% unless it was held for 5 years. So Senator Sinema, the other holdout, was left out of these negotiations between Manchin and Schumer. And so everyone kind of held their breath to see, would she bless this deal? Would she not bless this deal? Because she was really against any type of tax rate increases. And this bill did include some tax rate increases in the form of a corporate minimum tax. And Sinema has a lot of backing from the private equity industry as far as lobbying. And so everyone was kind of cautious whether she would proceed or not on this. And she held out for about a week or so. And then they announced that after further negotiation, they had taken out the carried interest provision. And to make up for the windfall, they ended up inserting a 1% excise tax on corporate stock repurchases, which is something that we saw in original Build Back Better negotiations. And so once they reached that agreement and they basically secured all 50 votes in the Senate, they passed the bill pretty quickly through the Senate with their 50 votes, and then the House passed it with no changes. And just for context, remember, the House did pass the Build Back Better Act back in November 2021, I believe. And so this went to the Senate, and then they renamed it the Inflation Reduction Act of 2022 because, well, everyone's talking about inflation and we have elections coming up. And so that was a catchy title, and sent it back to the House with a new name, even though technically it's the Build Back Better Act, just with a new name and a smaller bill. So that's what's happened lately, which just kind of went from 0 to 60 really fast, but we did pass a bill. So
Absolutely, yeah, and I appreciate your summary there because like it was sort of like, wait a minute, what's happening here as we're heading into the recess, right? So maybe you just give us kind of that high level overview of maybe the buckets, I guess I'll say, of what's in this piece of legislation, and then we'll kind of maybe break them down from there.
Yeah, so if you remember the Biden administration or the Democrats' talking agenda, their goal was to only increase taxes if they increase taxes for large corporations and wealthy taxpayers. And so the tax provisions in here kind of mirror that, mostly because the new tax, there's a 15% corporate minimum tax, which is an alternative minimum tax. And it's supposed to apply to a corporation's adjusted financial statement income, and only for corporations with profits in excess of 1 billion. And so they're trying to capture kind of the top tier of corporations. There's also, like I mentioned, the stock buyback excise tax, which is 1%, but only applies to publicly held companies and starts in 2023. The IRS is also getting an additional $80 billion in funding. And that's supposed to help them increase taxpayer services, enforcement, and modernize their technologies. There's been some political talk, and that this is going to up enforcement on lower and middle class taxpayers. But the goal, according to the Democrats, is to actually increase enforcement on wealthy taxpayers and corporations. But that is kind of, if you're auditing those kind of returns, that's definitely a higher skill set or expertise. And so it'll probably be a few years while the IRS kind of trains people to focus on the specific taxpayers, if that's their intention, which according to the Democrats is what they intend the money to go towards. And so there's also an extension of excess business loss limitations through 2028, which is like a minor tweak. And then there is a whole host of climate and energy tax provisions. And I'm going to let the other gentlemen on this call explain those to you because they spent a lot of time in those and they know more about that than I do. But we will be hosting a 5-part webinar series in September, going deeper into each of these tax provisions. So if something catches your attention, make sure you subscribe to our foresights to get those webinar invites. And we'll also be doing deep dive articles on each of these provisions to try to keep you up to date to see if you're impacted by this or if your business is maybe able to take advantage of any of these tax credits and incentives that we'll be covering and talking about today and throughout the month of September.
Well, that sounds great. Yeah, make sure you subscribe to be able to take advantage of those. So let's dig in with those energy credits. And maybe, Adam, I'm going to go to you first here. And you could talk to us a little bit about some of the clean vehicle credits, because I've already got some questions here related to that. I know I've fielded a number of questions myself from those that I have the honor to work with. So tell us what's in there, what changed, and really what we need to know about how this is all going to kind of come together here now that we have the bill enacted into law.
Yeah, sure. We'll kind of break it down into 2 buckets. 2 of the credits, the clean vehicle credit, as it's called now, formerly known as the new qualified plug-in electric drive motor vehicle credit. So I like the name. It's much shorter and easier to get out. That was the current 30D credit. The only change for what is currently in place is the fact that final assembly of these vehicles must be done in North America. It's the only change. It went into effect upon signing of the law. So as of August 17th, any vehicle purchased after that must be built or final assembled in North America. They did give us binding contract rules for those of you that have put deposits down, are waiting on vehicles to be delivered. You are going to be able to use the old rules, thankfully. The other one was they re-upped what we'll call the charging station credit, also known as the alternative fuel vehicle refueling property credit. And so this is where you go to plug in your electric vehicle or some of the other qualifying fuels that had expired at the end of 2021. For 2022, all they did was re-up it under the old rules. So those are the two things to keep in mind for 2022. In 2023, we'll see the ability to claim a credit on previously owned clean vehicles, as well as qualified commercial electric vehicles. The used clean vehicle credit will only be available for individuals, and then the commercial electric vehicle credit will be available to businesses where they're going to depreciate those vehicles, as well as larger vehicles that may not otherwise have qualified under the clean vehicle credit will be allowed to qualify for that credit with increased credit amounts as well.
So I guess my question would be, there are a lot of moving parts there. And if I'm somebody that's trying to make a decision, what are the things to think about, I guess, that you've seen so far, Adam?
Yeah, so obviously you've got to be concerned with the additional cost that comes with a clean vehicle, both purchasing and then also maybe the infrastructure that you need to charge the vehicle, potential repair costs. If insurance on that vehicle costs more, you definitely can't just look at it as simple as I'm going to get a credit, which will help offset some of the initial costs of the vehicle. You've got to be cognizant of the long-term maintenance and ownership costs as well.
Yeah. Okay. Well, let's go over to the maybe some of the other energy incentives. Derek, what else in there? Because there's a lot. There's probably some that are maybe fit into the, dare I say, esoteric, kind of specific in nature. What are some of the changes there that taxpayers need to know about?
Yeah, there was many changes to the clean energy credits, including some name shifts, which we won't go into. But I think the big picture changes applied to many of those credits. They extended the life of the credits, many of them through 2032, and then it starts to decrease for a couple years after that. So they extended the credit, and then they increased the credit in some regards. In other regards, they maybe lowered the benefit a little bit. But in the clean energy world, we've got an extension of most of those credits through 2032. For example, on the investment tax credit side, there's a business and a personal or individual level. Those both got extended. They added to the credit percentage to increase it, back up to 30%, which most people were used to from prior law. And that 30% goes into effect in 2022. There's some nuances within the law because of rules that were already existing. So if you had a project that started in 2020, say 2021, that's getting placed in service in 2022, there's some clarification that needs to be made as to whether you're going to get the 26% or the 30% because of certain rules that were already in existence. But for most of those credits, it was beneficial to folks. What they added in was the ability to get it for, say, standalone storage, and interconnection property, which is all part of the solar and possibly wind credits that these items come into play when those systems are being built. Which was good news. And I think some exciting information to add for the viewers is they added some bonus credit percentages, both on the investment credit side and on the production tax credit side. And many of those additional bonus credits are for domestic content minimums, energy community benefits, and qualified income, either economic or residential building benefits. Basically for locations either in census tracts or Indian land. Most of those bonus credits are going to require prevailing wage or internship requirements, and they don't start or go into effect until 2023. I think some of the other information that everyone needs to know of is that they also added a couple of new benefits to these energy credits. There's a new direct pay option, so you can elect to get a direct payment from the government in lieu of getting the tax credits. So that's designed to help not for profits, state political subdivisions, in rural electric co-ops, and there's a whole bunch of long list of entities that qualify, and put them on even footing with those for-profit businesses that were previously investing in that, and those entities would get a direct payment. The interesting part about that is you're gonna have to wait till you file a tax return, and then you're gonna have to wait for the IRS to process it. So there's some timing issues, and there's some procedures that you're gonna have to add additional information to get the direct payment, which is interesting. They also gave the option for partnerships and S corporations to elect to get a cash payment in lieu of the tax credit, which is very interesting. It brings into question about the ability to take that credit, and what about the at-risk rules or the passive activity loss rules for the partners?
Yeah.
Do you get out of bounds on those? I think, Damien, the other interesting fact on these is that there's now an ability to transfer these credits, which we couldn't do before. You can transfer them to an unrelated taxpayer, but you got to get paid in cash. It's not taxable to the transferor, and it's not deductible by the transferee, which makes sense, right, Damien? Because
Uh-huh.
you can't deduct federal, payments to the IRS anyways. So that makes sense that it would both tax exempt, and it'd be not deductible. I think it's important to note this one transfer, and then you can't transfer it again. And if you're the receiving the transfer of the credits, you're on the hook if there's a recapture event. So you got to take that into account.
Hmm. Yeah, I'm curious. I mean, obviously, it's very early on, and as it goes with almost saying, whenever we have new legislation, there's going to be a need for guidance and figuring out how this is all going to work. But yeah, I mean, how do you maybe envision that process working? The ability to transfer credits like that, it almost maybe create an enhanced market for them.
Yeah, I suspect the Treasury is going to come up with a form like they always do. There's plenty of forms out there that's going to show the transfer of the credit from one taxpayer ID to another taxpayer ID. And then there'll probably a form that has to get filed with the tax return. So you think about maybe like a 1099 W-2, something like that, a statement that shows the transfer of those credits. We don't know for sure, and obviously Treasury hasn't had a chance to dissect this all and put any kind of rules around it, but we'll be waiting on rules on how you can transfer those credits to and from parties. And this is a new thing. Generally, folks in the credit industry are familiar with state credits, and a lot of those state credits have been transferable. But federal credits, we've been preaching to clients for years that you can't transfer those. You can't buy and sell them. But here you go. On the energy credit side, you can actually buy and sell them. It's a very nuanced addition to these energy credits through the Inflation Reduction Act. It'll be interesting to see how that goes. One note is most investors, when they invest in these federal energy credits, they're investing both for the credits and for depreciation benefits. And the law did not address the depreciation benefits. So if you're wanting to get both benefits, you're still going to have to be a partner in the deal. That might mean that most people opt not to get a transfer of the credits and still do a typical deal structure because they need that or want that depreciation as part of the benefits they receive for investing in these energy deals.
That's really interesting. That's just practical application observation there. I appreciate that, Derek.
Yeah.
Well, I'll tell you what. Let's. I feel like we could talk all day probably about the energy
Yeah.
credits, and I think it's great that you're going to be doing these webinars coming up and taking a deeper dive. And we do have those resources. Again, they're in the chat, in the comments for this live stream here. So please, click on the links and again, get us any questions you have. But maybe why don't we transfer over and talk about, again, we're really going to need some guidance, I think. And that's that 15% corporate minimum tax, which I will say, and I know, Phil, this is an area you've been kind of looking at. It's I was initially say, it's 15%. It's a minimum tax. Is this like what we're talking about with Pillar 2 and the OECD? But no, it's not. So maybe tell us a little bit more about what this is and probably more importantly, who it maybe potentially could impact and apply to.
Sure. So within the framework, there's really two concepts that we focus on defining first. The first is AFSI, applicable financial statement income. That's really kind of the first component, and then from there we go to defining what is an applicable corporation. So starting with defining what the applicable financial statement income, the adjusted financial statement income. Basically, you start with, as the term implies, financial statement income per the method of accounting, the framework of accounting the company uses on its financial statements. So, for most U.S. public company, that's going to be GAAP. Maybe it's IFRS. Maybe you have statutory reporting, insurance companies, healthcare companies. Maybe if you're reporting on a statutory framework other than GAAP or IFRS, and that's what you issue your financial statements. Basically, you start with income per the financial statements. Then you have various adjustments. Your federal taxes get added back. They're non-deductible. There's a lot of other prescribed adjustments. For example, depreciation. You take into account your tax method of depreciation as opposed to your book depreciation. So that preserves the benefit for bonus depreciation. For pension plans, you take into account the taxable methods for pension items as opposed to the book methods. There's a handful of other adjustments, but you start with book income, you kind of work through these different adjustments to get down to this adjusted financial statement income. Then, determining whether or not you are an applicable corporation, you have to look at the historic 3-year period preceding the current tax year. So in order to be an applicable corporation, you have to have, for your financial reporting group, you have to have worldwide adjusted financial statement income in excess of $1 billion average over that 3-year period. And then if you are a multinational group with a foreign parent, for example, maybe you've got a company that's public in Europe and you're the U.S. inbound subsidiary of that foreign, then you look to really two tests. One is, does the worldwide group have income exceeding $1 billion? And then number two, does the U.S. group, and that could be a single entity as well as affiliated U.S. corporations under common ownership, do the U.S. entities within that reporting group have adjusted financial statement income in excess of $100 million over that 3-year period? There's other rules, taking into account if you have entities under common control that are not part of the financial statement reporting group, if you have partnerships, perhaps that are consolidated for financial statement purposes, but the U.S. taxpayer only owns a certain percentage of that partnership, you would only take into account their percentage. So, as they say, the devil's in the details as you work through who's in the group, who's not in the group, kind of work through these different adjustments. But essentially, those are the tests. Worldwide group, $1 billion average adjusted financial statement income over the last 3 years. U.S. members of the group in excess of $100 million. And interestingly enough, this could apply to both public and private corporations. So we talk about this applying to public corporations because that's generally who it's going to apply to, but there could also be some private companies that get pulled in if they cross those income thresholds for the $1 billion worldwide, $100 million in the U.S. So if you're an applicable corporation, then the calculation of the tax, and it's almost like you have to do the calculation of the tax to determine if you're an applicable corporation. If you are an applicable corporation, then you basically calculate the tax, the liability under this new alternative minimum tax framework, and then you're going to pay the greater of your AMT liability or your regular tax liability. There's also an NOL concept they're bringing in where you can calculate an AMT NOL and use that up to 80% of your adjusted financial statement income. Not too dissimilar from what we had with the old AMT. There's also a credits framework where there's a new framework for a foreign tax credit that you would take into account. They've also changed the framework for the general business credits to where now those general business credits can also offset the new AMT. So, for example, the R&D credit, companies can still get a benefit from the R&D credit. But you calculate the AMT, your regular tax, and then for your regular tax, you also include BEAT. So if a company has BEAT, that's going to be kind of considered part of that regular tax, and then you're going to pay the greater of the two. If the AMT liability is greater than the regular tax liability, you would pay that, and then you would generate an AMT credit that would carry forward and could be used in future tax years if the regular tax liability exceeds the AMT liability.
Yeah, this is a complex one, and I think it's particularly interesting to me in many respects because it's well, I mean, it's maybe been tried once before, but not long lasting. So this concept of starting with this book income and creating another minimum tax, it certainly adds complexity, and there's probably some some that like it and some that don't. But I mean, I think what I was hearing is maybe it's about 150 corporations maybe that will be subject potentially to this, but maybe about 1,000 in total that kind of have to figure out if they're subject to it. So yeah, a lot of math and a lot more that we'll have to find out about. But I wanted to maybe switch over, Phil, to talk about the 1% stock buyback tax. I mean, I know that was sort of a compromising factor that got added in there, as Elena was telling us, as it kind of got to the finish line. What is that all about?
Yeah, so that's another provision. This provision was in the original Build Back Better Act. It got stripped out in the first proposal of the Inflation Reduction Act, and then it got put back in as a compromise, like you went over, between taking out the changes to the carried interest rules. But essentially, what it does is it creates a 1% excise tax on the fair value of stock that a public company repurchases. There are rules that pull in, primarily it's going to apply to domestic corporations, but it could also apply to if you have a foreign public company with a U.S. subsidiary, and the U.S. subsidiary is repurchasing stock on behalf of the foreign parent, that could get pulled in. And then there's various exemptions. So, for example, if the total value of all stock repurchased during the year is less than $1 million, that's generally going to be exempt. There's some carve outs for things like, employee stock purchase plans, ESOPs. There's also a sort of a trade-off that if a company is issuing new stock during the year, then that gets netted with the stock repurchases. But essentially, you determine the value of the non-exempt stock repurchased during the year, and that's what's going to be subject to the excise tax.
Okay.
And
thank you. And I know you have a good article out there on our foresights on that we put a link to in there. But one question that I have gotten, and you kind of indirectly answered it, but I just want to hit it here, is who is maybe subject for this tax? Is it shareholders or the corporation itself?
So it's the corporation that will pay the excise tax, and interestingly enough, that tax is defined in the bill to be a non-deductible federal tax. So that will be paid by the corporation. It will be non-deductible by the corporation, so no deduction on the corporate return for that tax. And then from an accounting perspective, it's interesting because usually when shares are being repurchased, that's often accounted for through equity as opposed to through the P&L. And often the direct costs of the repurchased are also accounted for through equity. So so far we don't have any guidance from FASB, but there's some expectation that that tax from an accounting standpoint may be accounted for through equity as opposed to going through the financial statements, or through income in the financial statements. But that remains to be seen if there's going to be any guidance on that.
Yeah. Well, guidance is the key, right? On all these provisions in a lot of respects. So maybe what I'll do is open up to the group. Maybe, Elaine, I'll see if you have anything initially that comes to mind that maybe we haven't talked about. And there's a lot in there. And obviously we're focusing on the tax provisions. There were a lot of non-tax things that were the focus of this legislation as well. But I don't know, Elaine, is there anything that comes to your mind from our conversation we've had so far that we maybe want to highlight at this point?
Yeah, well, you mentioned guidance, and that's something that we'll all be waiting for in the coming months, because a lot of the provisions leave a lot of uncertainty or gaps that the Treasury and IRS will be expected to fill. And, the IRS just caught up on processing all their 2021 paper returns, and we're going into the 2022 filing season here shortly. Right. And so you only have a couple months in between, and the IRS had other priorities the IRS had other priorities they wanted to get through the end of the year. And then, Congress passed another new law. And so I'm sure they're reshuffling their resources and priorities to see, when they're actually going to be able to pass any new guidance. And so that's a big uncertainty, and a lot of these can't be implemented without further guidance. And so we'll just be watching for that in the next coming months, probably next year, honestly. And then secondly, even though we're still waiting for guidance, we do have enough information where we can meet with our clients. And if anyone's not a FORVIS client yet, you can become a FORVIS client. We can walk you through this, but we can totally sit down with you and, talk, any of this applies to you or your business, and any considerations or tax planning or compliance considerations that you should be keeping in mind going into 2022 and beyond. And so it's very important to, not just skim over this or ignore it, even if you think it doesn't apply to you, but it's worth a conversation with your tax advisor, just to see how this could potentially impact you. And certainly if you can take advantage of some of the tax credits and incentives in this bill, because there's a lot out there. And so we're going through it all, and we're happy to walk you through it too as well.
Yeah. I don't know if anybody else has any other areas that come to mind there. I mean, I know you touched on the funding a little bit, Elena, and that's probably again, like I was saying, sort of with the minimum tax, some like it, some don't, some maybe are indifferent. But there's certainly more to come there, and kind of understanding what that's going to look like. But yeah, were there other provisions maybe that anybody in the group here is getting questions on that you'd mention?
I would just add, within the minimum tax framework, probably the most complex area is going to be foreign operations. So, within the bill, there's very, very little guidance around how you incorporate foreign items of income. And it just specifically says, the Treasury to issue regulations describing how to account for all these various items of foreign income that get pulled in. So I expect that will be a very hot topic, given that most of the corporations that this apply to are going to be the larger multinationals. And so those international rules within this minimum tax framework are going to be of interest to a lot of folks. And folks will be watching very keenly to see what guidance the IRS puts out on that in the near future.
Very interesting. That's a great point. Probably one last thing I'll mention, I'm going to get everybody's takeaway from today, but I know one area that we've been particularly watching, we've even mentioned it on a previous episode of our Simply Tax Talks here. I think it was back at the beginning of February. We had Mike Boenzi on, who is our national leader of our R&D tax practice, tax credit practice, I should say. And there was a big change that went into effect, if you recall. It actually came about under the TCJA, so it's been kind of years in the making here, where we had a sunset that occurred. And so we're now required, there's a mandatory requirement to capitalize research and experimentation costs and expenditures. So there's actually a webinar tomorrow that they're doing, and there's a lot of more you can learn through our website as well. So I would encourage you to look more about that. But the reason I mentioned that is there was some talk early on about how, maybe the sunset would get pushed out on that. So that mandatory capitalization requirement wouldn't kick in for 2022 or calendar year 22. It's effective after 12/31/21. And that was not in this bill. So just to kind of highlight that maybe we'll see it later, but we haven't seen it now. And actually our next episode of our Simply Tax podcast, we'll talk more about that with Mike, in fact. So stay tuned for more there. So I guess that let's get everyone's top takeaways for today. All right. Why don't we start with you, Derek? What's your kind of top takeaway you'd leave everyone with, and maybe anything else that you'd want to add that didn't get brought up so far?
I think from an energy credit standpoint, if you're a business and you were looking at investing in this in one way, shape, or another, whether through tax planning or save on utility costs, that credit just got more attractive, whichever one, whether it's the geothermal, whether it's the hydrogen, whether it's the production tax credit that's involved. So many different tax credits just became more efficient and effective for whatever purpose you would need them for. I think also would add, if you're a not-for-profit governmental entity, somebody who had said those benefits won't work for me because I can't use that credit. The elective payment and transferability will make these more attractive and put you on more even footing and utilize those credits. And I think there's a lot of opportunities for partnerships and S corporations to plan around utilizing these credits. And then for a big picture, what we didn't mention, there's an extra added benefit to the energy credits where you can elect to carry excess energy credits back up to 3 years and forward 22. And in the general business credits, typical time frame is a 1 year credit carryback and forward 20 years. So there's a bunch of opportunities for folks that normally wouldn't have or thought they could take advantage of the additional benefits for energy credits that are now available under this new law, and you should definitely look at them again.
That's a great point, Derek, and thanks for highlighting that, because there's a lot of planning, and it's, like you said, more attractive. So that's great. Adam, What do you got? What's kind of your takeaway?
Yeah, so to kind of parallel with Derek, a lot of these energy credits have what they call a base credit percentage and then a bonus amount that, typically can be 5 times, for example, what the base amount is. But to get that, Derek mentioned the wage requirements, the apprenticeship requirements. And so there's got to be some due diligence because, we as tax preparers or our clients have to decide whether they qualify for that base amount or the bonus amount. And if they, feel they qualify for the bonus amount and they don't, there are not only, repayment of wages that maybe were too low, but there's penalties and interest that may apply as well. So these credits have gotten a lot more complicated than they possibly previously used to be.
Good point. Well, yeah, it's like whenever there's something added, often there's some complexity and some things to be thinking about. So yeah, definitely make sure we're dotting the I's and crossing the T's, so to speak. Phil, what's your takeaway?
Yeah, I would say a couple of positive takeaways within the minimum tax framework as compared to the original campaign proposals from 2 years ago. One is that it preserves and you could argue enhances the benefit of the R&D credits for companies that are going to be subject to the tax, and then also bonus depreciation, cost segregation studies. The value of those is preserved in this new measure. So, those are definitely planning opportunities for companies that will be subject to the minimum tax to make sure that they're, taking maximum advantage of those provisions to use those favorable pieces to offset this minimum tax to the extent it applies.
Yeah. And I guess speaking of TCJA related changes is, and maybe another plug for the cost segs there, right? We have 100% bonus depreciation through the end of this year and then starts to ratchet down 20% a year starting in 2023, right? So, maybe getting that cost seg in looking at that, again, all facts and circumstances considered, isn't a bad thing from that perspective overall. So I appreciate that. All right, Elena, help us land the plane here. What's your takeaway? What should everybody be kind of walking away with as their thought here about this Inflation Reduction Act for today?
Yeah, I think, it feels complete in a way where we actually got a bill passed. But something to keep in mind, we also have midterm elections coming up. Everything's quiet now, but once elections pass, if the Democrats lose control of the House and or the Senate and Republicans take control of Congress, they have said that they want to maybe perhaps change some of the rules that just passed. For example, IRS funding. They're not big fans of that. And so it's something just to keep in mind and keeping an eye out for. So not only IRS and Treasury guidance on this bill, but potentially how Republicans are going to react if they do win midterm elections. So a couple things just to watch out for, but it's definitely quieter than it was before all this passed.
Yeah, there's just a lot going on, I think. And like you said, you always have to know where you are in the cycle, and maybe we'll see an extenders package after the election. Again, we'll have to see how it goes. And it's our favorite saying, right, Elena? My crystal ball is as good as yours. So we just have to keep going, and we'll have to keep doing more of these our live streams to do that. So, one last point I might make, and actually, Phil, as you were saying, your point about kind of where the corporate minimum tax ended up maybe compared to the proposal. And it reminds me of a good point, right? That where we were at the end of December and the things that we were talking about, a lot of those things, the majority of those things really did not occur and didn't find their way themselves into the final bill that we saw here, even though it started with that same piece of legislation, so to speak. Obviously, the final bill looked nothing like those proposals. So, depending on if you were a fan or not of some of those provisions, particularly perhaps I'll say in the estate and trust arena, those didn't happen. But again, to your point, Elena, right? We did have actually drafted legislation. It's sitting on a shelf somewhere. So you just kind of have to watch what happens in the election cycle, and if maybe some of those provisions could come off the shelf someday. So again, I think it's just more reason to keep track of all the headlines and where things are going. But for today, a lot to think about here, and I want to thank everybody here on this call for joining us and sharing your insights. We're going to put, it's not in there right now, we're going to add to the comments everybody's contact information. So if you have additional questions or something that, like Derek mentioned about deal structure or what might happen, reach out to them, please. They're all great at what they do. I'm obviously biased, but I certainly think they're great at what they do, and think you will as well. So, I also want to thank you as the audience. As always, stay in touch. Let us know what you think. We like your feedback, so please add it to the comments. Connect with us, subscribe to the channel, all that kind of good stuff. For now, we'll call it a day, but we'll be back in the feed pretty soon here as we watch and continue to monitor all the changes that are happening in the tax world. So for today, thank you, and thanks for watching.